As of Sunday, January 25th, 2026 at 3:59 p.m. EST, the market is currently closed. SoFi Technologies Inc., trading under the ticker SoFi on the NASDAQ, finished its last active session on Friday, January 23rd, 2026 at a closing price of $25.85. This represented a daily decline of 0.92%, with the stock oscillating between an intraday high of $26.13 and a low of $25.60. While a one-day dip of less than a percent might seem like standard market noise, what the surface-level data isn't telling you is that SoFi is currently caught in a massive tug-of-war between institutional accumulation and retail skepticism, just 5 days ahead of its critical Q4 earnings report. While the general expectation is that SoFi will simply continue its streak of incremental profitability, the reality is that the company is quietly transitioning from a high-growth fintech disruptor into a diversified financial titan that looks more like a modern-day JP Morgan than a digital lender. The big surprise that most investors are missing is the explosive growth in their technology platform segment, specifically Galileo and Technisys, which are now powering nearly 160 million accounts globally. This isn't just about personal loans anymore, it's about owning the plumbing of the entire global financial system. When you look at the underlying volume, over 34 million shares traded hands on Friday alone, signaling that the smart money is positioning itself for a major volatility event. The common narrative surrounding SoFi stock is that it's a boom or bust play, heavily dependent on interest rate cycles. People look at the Fed and assume that if rates stay higher for longer, SoFi's lending business will eventually suffocate under the weight of defaults. But let's challenge that. The reality is that SoFi has spent the last year aggressively de-risking its balance sheet, shifting its focus toward high-FICO super-prime borrowers who are effectively recession-proof. While many individuals using basic investing sites or a standard individual brokerage are worried about the next quarter, institutional giants like Vanguard and BlackRock have been increasing their stakes significantly, with Vanguard now holding over 107 million shares. They aren't betting on a simple lending play, they are betting on the financial services productivity loop that is finally starting to generate massive margins. If you've been tracking the movement of NVIDIA stock or Apple stock lately, you know that the market is rewarding companies that can show clear paths to sustained high-margin revenue growth. SoFi is entering that territory. In the last year, the stock has nearly doubled, rising from its 52-week low of $8.62 to its recent heights near $32.73. This momentum isn't just hype, it's driven by the fact that SoFi has effectively captured the high-earner, not-rich-yet demographic, young professionals who are using the SoFi app for everything from checking accounts to options trading and even private equity access. This kind of customer loyalty is exactly what traditional firms like Fidelity and Schwab Intelligent Portfolios are fighting to keep, but SoFi is winning the battle for the next generation's wealth. Recent trading sessions have shown a fascinating pattern. Even as major indices experienced slight pullbacks, SoFi's support levels around the $25 mark have remained remarkably firm. This suggests a high level of diamond hands among the retail base, many of whom started their journey using the Robinhood app or SoFi Invest and have now graduated to more complex strategies. We're seeing a significant increase in call option activity at the $27 and $30 strike prices for the upcoming month, indicating that traders are expecting a positive earnings surprise on January 30th. If the company beats the consensus EPS estimate of 12 cents, we could see a massive short squeeze that catapults the price back towards its yearly highs. Let's get into the mechanics of why this matters for your portfolio. When you look at online investing today, you have choices ranging from a self-investing setup to managed solutions like SoFi Robo-Advisor or Interactive Brokers trading platforms. SoFi has managed to bundle all of these into a single ecosystem. This is their secret weapon. Once a user signs up for a student loan refi, they are immediately funneled into SoFi Money and SoFi Active Investing. The cost to acquire that customer happens once, but the revenue generated from them happens for decades. This is fundamentally different from the business models of older companies that rely on high fees and fragmented services. I want to hear from you on this. Are you currently holding a position in this fintech leader, or are you waiting for a post-earnings dip? Comment below how many shares of SoFi you currently hold and what your average cost basis is. It's always helpful to see how the community is positioned before these big moves. Focusing on the immediate horizon, the institutional activity we saw in late 2025 carried over into early 2026. J.P. Morgan Chase & Company notably increased their position by over 800% in their most recent filings, which is a staggering vote of confidence from one of the most conservative names in banking. This kind of backing suggests that the expectation of SoFi being a risky startup is finally being replaced by the reality that it is a systemic player in the financial services sector. Furthermore, the recent launch of their SoFi USD stablecoin shows they're not afraid to compete in the digital asset space, directly challenging the dominance of traditional payment networks. To understand where we are going, we have to look at where we've been. SoFi started in 2011 as a social finance company focusing on student loans. Today, it's a nationally chartered bank with over 12.6 million members. Their business model is split into three core pillars: lending, the technology platform, Galileo, and financial services. While lending still brings in the most revenue, the financial services segment recently turned profitable, which was the holy grail for analysts. This segment includes the SoFi credit card, SoFi Invest, and their high-yield savings accounts. By offering rates that far exceed what you'll find at a local branch, they are sucking deposits out of the traditional banking system at an alarming rate. The upcoming catalysts for 2026 are substantial. Beyond the Q4 earnings, we are looking at a potential massive expansion in their home loan business. Historically, mortgages were a small part of their portfolio, but as interest rates began to normalize in late 2025, SoFi began building out its infrastructure to capture a larger share of the $35 trillion in American home equity. If they can successfully cross-sell mortgages to their existing 12 million members, the revenue upside is almost hard to calculate. It would turn SoFi into a full-scale competitor for every major bank in the country. However, the path isn't without risks. The reality of the current economic environment is that credit quality is paramount. If we see a sudden spike in unemployment, SoFi's personal loan portfolio, even with its high FICO borrowers, could see rising charge-offs. This is the tension that keeps the stock from trading at an even higher multiple. Investors are constantly weighing the potential for massive growth against the inherent risks of a relatively young bank holding company. But so far, management have proven they can navigate these waters, consistently beating guidance and raising outlooks quarter after quarter. When you compare SoFi to its peers like Robinhood or Affirm, the difference is the banking charter. Having their own bank allows SoFi to use their own deposits to fund their loans, which significantly lowers their cost of capital. While companies using Interactive Brokers platform or other third-party clearinghouses have to pay fees and deal with middlemen, SoFi is vertically integrated. This means that as they scale, their profit margins should naturally expand faster than their competitors. This is why the institutional smart money is so focused on their EBITDA growth rather than just their top-line revenue. Looking at the technical indicators, the 200-day moving average has become a solid floor for the stock. Every time it is dipped towards that level, buyers have stepped in aggressively. On the upside, the $30 level remains a psychological barrier. We've seen several attempts to break through and hold that level, but it has required a significant catalyst to stay there. The January 30th earnings call is precisely that kind of catalyst. If the guidance for the rest of 2026 is strong, especially regarding their technology platform's international expansion, we could see $35 or even $40 as a realistic target by mid-year. To summarize the landscape, the expectation was that SoFi would struggle to maintain its growth as it matured. The reality is that its growth is actually accelerating in its most profitable segments. We are seeing a company that has successfully moved beyond its student loan roots to become a premier destination for online investing and comprehensive wealth management. The contrast between what the bears say, that it's an overvalued fintech, and what the data shows, a highly efficient, profitable bank with a tech company multiple, is where the opportunity lies. Whether you are using Fidelity Wealth Management or you prefer the fast-paced nature of the Robinhood app, it's impossible to ignore the impact SoFi is having on the industry. They have forced the old guard to innovate, and in doing so, they have carved out a massive niche for themselves. As we head into the next week of trading, keep a close eye on the volume. If we see sustained buying pressure leading up to Friday, it's a clear sign that the market is bracing for a beat and raise scenario. SoFi Technologies has moved from the fringes of the financial world to the center of the fintech conversation. The expectations were high, but the reality is looking even better. It's a classic case of a company being misunderstood by the broad market while being quietly accumulated by those who see the long-term vision. We are watching the transition of a disruptor into a dominant leader, and for those who have the patience to look past the daily swings, the depth of this opportunity is only just